Hello. In an earlier video, I discussed the concept of the goal of financial management or the financial goal for for-profit businesses. And we sort of came to a conclusion that it is probably not just that they make profit, whatever that means, but rather it's more specifically that they have to generate enough cash flows from their operations to be able to cover the cost of capital for the investment dollars that they must raise to fund those operations. And that they probably don't want to just cover that. They want to have some left over so that they can grow the value of the business over time. And while that sort of nuanced sort of goal seems fairly straightforward, I think the more interesting thing and the thing that sort of leads to the need for finance and finance classes is the issues and the challenges that arise in trying to get to that goal. And so this video is really to help better explore why it is so hard for businesses to achieve that goal. And hopefully that will sort of motivate a discussion about how important it is to have good tools to help deal with this complexity. So the overall learning objective here is for you after this, if you were asked by somebody, hey, why is it so hard for a for-profit business to be able to manage itself in a way that it generates these excess cash flows and builds value, that you would want to be able to respond with the challenges that they face, and ideally that response would consider the fact that they're in a competitive market. It would speak to how that competitiveness impacts the demand and sale price of their products. It would speak, to how all of that plays into the amount of variable and fixed costs that they have and what they need to do to keep those in line with their sales, cash flows, and it would speak to the investments that they would want to make to remain competitive and the cost of the investment capital required to fund those investments, and generally that's where the complexity lies. And so to do that, we're just going to start out with hopefully something that's familiar with you or to you, and that would be a simple supply-demand curve. I think that most of you, I would assume, are familiar with this very general idea that with the curve, there is some, if you will, price at which it doesn't matter if the price gets any higher than that. The demand isn't gonna drop. Well, sorry, say that differently. There at some point, the price is so high that demand drops to zero. Nobody's willing to pay more than a certain price for that. But as the as the price falls, more and more people are willing to pay that price, that lower price, and so demand, which is the quantity on this axis, goes up. And that'll continue to go up until there is some price at which the price is so low that, quite frankly, everybody that wants it is willing to buy it. And so quantity won't go up beyond that. It'll just kind of stop there. And on the supply side of it, the way to think about it is that there is some level of price at which, if you set the price below that, nobody's willing to supply below that, so the quantity goes down to zero. But as long as you can at least achieve their minimum price, you have people who are willing to supply. And as the price goes up, you have more and more people that are willing to supply. And you kind of hit a point up here, I don't really show this well, but where you've sort of maxed out, if you will, on the quantity side. There's absolutely no more you can supply. And so at that point, it really doesn't matter if the price increases or not. The quantity is not going to increase anymore because you just don't have any capacity to supply anymore. And then the notion, of course, theoretically, is that the price that you will observe in the market and the quantity that actually gets sold will be where these two cross. Um, there are some shortcomings to this, and they're really tied into, in my view, the assumptions. And I'm not saying that this makes this a bad theory. I'm saying that it makes it not as useful for us to understand what really goes on inside of for-profit businesses. Part of that is that this is a market model for a single homogeneous product, and it really is intended to speak to how much the price and quantity sold in the total market is. There is an implication in there about who's going to sell what that maybe isn't explicit. It's hard for you to see that explicitly, but this assumes that it is basically, if you will, one product. So it doesn't take into consideration that sometimes two companies will have similar products, but they'll be different in terms of some particular quality or brand recognition or convenience or service or something else. In fact, it is the job of businesses to have products that are different from the other products that are being offered. If you stop and think about it, businesses succeed because they offer products that meet a customer need. And if there's already a product out there to address a customer need, there's really no point to have another business offering that same product unless they can do it at a substantially lower price. So more often than not, what you see are businesses offer a slightly different product, and maybe by the way that they make it different, they can sell it cheaper, or maybe by the way that they can make it cheaper and therefore can sell it cheaper, or the way that they make it, it makes it more desirable so that people are willing to pay more. And so that's really, that's the essence of a business, and this sort of assumes all of that away or simplifies it. Second is it's what's called a single period model. Think of that as an instantaneous model. And so the idea there is there's no timing considerations for I got there first, or that I have the opportunity as a buyer or a seller to see what happens in the market and make an adjustment. There's none of that sort of dynamics to it. It assumes that all buyers know everything about all other buyers, all sellers know everything about all other sellers, and they know it all instantaneously at the same time. And I assume, I can only guess here, that somehow that leads to the result. It assumes that it's perfectly competitive, no single buyer or seller can influence price. And this last part, it's an equilibrium model. And what we mean by that is the entire point of the model is to determine the quote unquote fair or equilibrium price. Now, the easiest way for you to imagine that would be to say that let's just imagine that this is a market where all buyers go in and submit the prices that they're willing to buy at. All sellers go in and submit the prices that they're willing to sell at. And somebody stands in the middle of that and does a matching between all of them that defines this crossing point and says, you buyers will get your needs met at this price, you sellers will sell products at this price, and those of you who are buyers that aren't willing to pay that price won't get anything, and those of you sellers who aren't willing to accept that lower price, you won't sell anything, and that's just the way it works. So that's a problem for us. The other thing that's a problem for us is that, again, it's for an entire market. It doesn't stop and think about the fact that I need to know what my share of that market is. And so one of the things that we can do to start to understand what it implies, and maybe that will help you to understand why I think it's a limited model in terms of helping us with our particular problem, is that, think of it as how this demand curve, for example, is built up. There is this individual buyer, right, who's willing to buy this much quantity, and they're willing to pay up to this price. And then there's another buyer who's willing to buy this much quantity, but they're not willing to pay quite as much. And so at this point, you could say, oh, well, if we satisfy both of them, then we will have sold this much quantity, but we will have sold it at this price, right? So that's kind of the way that that works. And of course, then you go down the stack, and there are additional buyers that want quantity, but they're willing to pay less, all the way out to this last buyer who is effectively saying, well, I want this much, but I'm only willing to pay this much, and so beyond that, there are no more buyers, and so he represents sort of the last bit of quantity that is out there. On the other side of that, you have sellers. It's the same thing. You have a seller who's maybe willing to sell at this price, and they have this much quantity to sell. Another one at this price and this much quantity, and all the way up. Okay. Well, one of the implications of this model, this approach, if you believe it, would be that only buyers that are on this side of the cross get to buy anything, and only sellers who are on this side of the cross, right, where the two lines cross, get to sell anything. And so if you're a supplier out here, you don't get to sell anything. Now, stop and consider this. There's a buyer over here. Let's just say this is $100. There's a buyer over here that's willing to buy this much quantity at $100. There's a seller over here that's willing to sell, something near that quantity at less, maybe $90, right? And in the real world, that buyer may wind up buying from that seller. That's just the reality of it, right? And quite frankly, they're both happy. And in fact, that happens a lot. And it could happen for a lot of reasons. This seller may offer, maybe has a really favorable brand name or whatever else. And the flip side of that, you got, this buyer down here, let's just say, who you're looking at and saying, wow, he was willing, let's just say this is $30. He was willing to pay $30. There was a seller out there that was actually willing to sell at less than $30, but he doesn't get to buy from that seller. He doesn't get anything. And so clearly that's not realistic, because quite frankly, a buyer that is that cost conscious is likely to go out and make a point of being the first person to get there and get their order filled, right? And quite frankly, that's just the reality of it. And so the reality there is that, again, the sellers often purposely differentiate on quality, so that buyers that are willing to pay higher prices come and seek them out instead of just looking for the lowest price. Timing has a lot to do with it. The example I like to use is concert tickets. This is a single period model, which means everybody knows and makes their transaction at the same time. I think you've had experiences where maybe there's a concert out there that you would love to see, and you'd be willing to pay $100 for a ticket to see that. You go to the concert venue and try and get the ticket, and lo and behold, they were $25, but they're all sold out. And they sold them to somebody that was only willing to pay $30 for them, right? But they bought all of them. And so now, if you want them, you have to pay enough to convince that person who bought them at $30 to give them up. And that may be something more than $30. And, of course, their whole business is of brokers and that kind of thing. Well, part of the reason that they got them and you didn't is they were willing to stand in line to be one of the first people on a first come, first served basis to get the ticket, and you waited. So, timing matters. The information matters. Buyers rarely know what other buyers would be willing to pay at the time that they make a purchase. In almost every market, it becomes one of those things that says, well, I know what I'm willing to pay, or what my maximum is that I'm willing to pay, but I don't necessarily know whether that's higher or lower than the typical buyer. And so, I don't know whether or not, if I pass up on making this purchase, I'm not going to get another opportunity to buy. So when I find somebody that's willing to sell it lower than what I'm willing to pay, I may go ahead and act on that without doing a lot of seeking for lower prices, just because I'm not sure there will be any. All right. Same thing with competitors. When they set their prices, they really don't really know much as sellers about what the other competitors are going to set their prices out. They have to set it at something, so they'll put it out there, and then they'll see how the market responds to it, both how customers respond and how competitors respond. There are relationships where certain buyers and certain sellers are just used to doing business together, and we'll continue to do that business together, even though there may be a cheaper seller option out there. The relationship and the stability of it and so forth has value. There's, the reality as a result of that is for any given sort of product market, there isn't a single price that everything clears at. Even at a particular instant in time, there's multiple prices. They adjust dynamically over time. They adjust to competitive pressures. So the real world's a bit more messy than this model, and it's that messiness that we have to embrace in order to understand why it is that the financial challenges are so great for a for-profit business. All right, so here's more of in my view, how the real world works. At the end of the day, you've got these demanders that have a quantity that they want, and we've shifted. You'll see we've flipped this. So quantity is on the up-down axis, price is on the left-right axis, and so all we've done is flip the direction of these, and you got suppliers the same way. But the reality is that this buyer, let's say, that's willing to pay a high price, may go get some from this seller, some from this seller, and some from this seller. They aren't necessarily going to say, oh, I'm only going to buy from this person and, kind of work my way up. Same thing with the rest of these. They're going to go out as long as the seller is willing to sell it less than they're willing to buy it, they're a viable option. The result of that, an important implication of that, is basically that not only is there no single price, but that basically means that every seller has the possibility, as long as there is a buyer that's willing to pay more than their minimum selling price, they have a possibility of making a sale. And it just becomes a question of that. So again, no single price at which all sales take place. There are individual pairings and negotiations, and that's what results in this. The buyers and sellers tend to seek each other out in an inefficient way from the perspective of the economic model. But we believe these behaviors exist. For example, there are buyers that are willing to pay higher prices, and often those are what we would call convenience buyers. So they're buying on the basis that I'm willing to pay a higher price to have no hassle to get my need filled. So the last thing they're going to do is go look for the lowest price. They're just looking for something that's less than what they need, and if they get it, boom, a sale is done. There are sellers that are willing to accept lower prices, but that doesn't mean that they only go after lower prices. Quite frankly, some of those sellers are some of the most aggressive negotiators and will try and go out and secure a higher price than the minimum that they're willing to accept and work their way up. And so those sellers potentially get paired up with buyers at a lot of different ranges. And as we said, timing matters. Bargain shoppers may get to the best price first because they're willing to stand in line or sit online or whatever else and be the first one there. The implications for price are this. There is not a single price. There is a range of market prices within which products have some demand. And so if you are a seller and you have priced your products within the range of where there's buyer demand, there is some probability that you will sell some products. If your prices are towards the lower end of the range, you probably have a great likely to have a greater demand than prices that are at the higher end of the range, and therefore you're also likely to get more sales than those that are towards the high end of the range. And if your products are priced above the range, then you're probably not going to have much demand at all, and you probably won't have a lot of sales. You may still have some, or you may have none. On the quantity side, keep in mind that demand does not necessarily translate into the quantity sold. It's dependent on things like availability, so there may be high demand, but you don't have the goods on the shelf right now, so you don't get a sell. It has to do with promotions, which is advertising, basically, awareness, creating awareness for your product. If there is a demand for products at the price point that you're at, but people aren't aware that your product is priced at that point, then they can't buy it, and so it doesn't translate into sales. Distribution, that it's actually available at the time that they want it. Again, we've talked about from a convenience standpoint, that's important. Buyer search patterns. Sometimes you can do all of that right, but you just happen not to be in sort of the mainstream of buyer visibility and where they normally look. So, for example, I am aware of some places where, quite frankly, very few buyers looked on the internet. It's, local towns, they don't look on the internet for stuff. And so they tend to only go to the places that they've always gone to. And I know how weird that sounds in this day and time, but if you're somebody who primarily promotes your products and your prices on the internet, you just may not sell much. The demand for the individual seller's products is dynamic as well. It shifts based on buyer preferences shifting, based on the knowledge that they have about, that maybe there's a competitor out there that has a product that has a better quality that they want, or something they value more, or possibly a competitor has lowered their price or whatever else. And so as a result of that, and here's kind of the key point for you, one of the single hardest things that a company can do is forecast any meaningful distance into the future what their sales will be, what quantity they will sell. And particularly if, as part of that, they're saying, well, let me just assume a price that I'll sell at and a quantity that I'll sell at the same time. Very, very hard to do. And therefore, revenue forecasts, which are quantity times sales, obviously, are very, very hard to do. So, how does that translate into that kind of micro reality? How does that translate into the challenges for a business? Pretty simple. So let's just start out at the beginning. The total sales for a company is the sale price, which we'll call P, times the quantity sold. All right. Now you'll see down here, I'm saying that quantity sold equals quantity produced equals Q. So I'm just putting a Q up in here. You'll see here in a minute why I do that. But basically, total sale price, total dollars worth of sales equals the price I sell at times the quantity I sell. All right. Not sure what I did there. There we go. Then from that, in order to get to the operating cash flows, you have to figure out the costs. And so there are variable costs and fixed costs. The per unit variable cost is the cost that's directly tied to the unit of a product. So we usually think of that as the cost of making the product. Sometimes there will be some other cost that you incur that isn't really about making the product, but is very much tied to the sale of it, let's say like a commission or something. But it's all the costs associated with getting the product into the customer hand that are per unit costs. And then there is so your total variable costs are the per unit cost times the quantity that you produce, right? Because it's not about how much you sell there. You incur those costs when you produce the product, not necessarily when you sell it in most cases. And then there is a gross margin that is simply the difference between the total amount of money you made from selling the products less the total variable costs. So graphically, you can see you have your big square that is the area of this square is your total sales amount. It's the price times the quantity. So the variable costs are the cost times the quantity. So it's the area in this square. And what's left that still shows up here is the gross margin. Okay. And so pretty much that's what you have to work with to pay off whatever else. So now you have to worry about that. Not only do you have those variable costs, but you have the fixed costs. All right. And so you basically start out with this gross margin. In order for you to have positive operating cash flows, your gross margin has to be bigger than your fixed costs, period. The gross margin is going to vary based on the quantity that you sell and produce, because that's going to affect both your sales, your total sales, and your total variable cost. But the fixed costs themselves don't change based on quantity or cost sold. And so, you're ultimately the challenge becomes, how do I know whether or not I'm going to have a big enough gross margin to cover these fixed costs, right? And so, because of that, that's really where the variability comes. It's not that the fixed costs are varying that much; it's that the variable costs and the sales are varying. So, a simple way to think about this: so you've got your total sales amounts, the whole big square. Your total variable costs are this red square. Fixed cost is the blue rectangle here. And what's left over between those, that's your operating cash flows. All right. And again, I've sort of simplified in this example that the quantity sold and the quantity produced are the same thing. So what happens now, if you'll kind of think about it, we're going to squeeze down the quantity and say, well, maybe we don't sell as much. Okay. So these go down to whatever amount they are. Why did the fixed cost get wider? Because again, the total area of this rectangle has to stay the same, right? You made it shorter, so it's got to be taller, because that rectangle, the area of that rectangle, represents these fixed costs. And so when you did that, that pushed up against the remaining gross margin, and you have a much smaller operating cash flow. Flip side of that, I could make it much wider, and by making it much wider, again, the area of the rectangle stays the same. Because it's wider, it doesn't have to be as tall, it can get smaller. That leaves a lot more left over as operating cash flows, and so that's kind of the way that those shift. You can also have a situation like this. We're going to relax this assumption and say that the quantity sold is less than the quantity produced. Maybe I forecast a certain amount of sales, and so I produced based on that, but it just didn't happen. And so now I've got this problem where I've got the fixed costs that are consuming an amount here, right? But I also have this amount here, right, that sticks out to the right of everything. That also has to be deducted off of the gross margin to get to operating cash flows. And so by virtue of that, I may have negative cash flows. So even though my per unit costs were in line, all that sort of stuff, because I have a mismatch between the quantity I produced and the quantity I sold, I could have negative cash flows. I could have it the other way where I underproduce. Now maybe I had some in inventory from a prior period, and so I'm able to sell that or whatever else. But the bottom line is that because I underproduced, my operating cash flows are not just this amount at the top. I also saved a whole bunch of per unit costs at this point, and so my operating cash flows get to be real big. So that will happen if the quantity sold is greater than the quantity produced. So at the end of the day, all of those things can cause your operating cash flows to move around a lot. Now, again, I want to emphasize the thing that didn't change in any of the examples are the fixed costs. The area of these fixed costs the same in all these examples, and yet the operating cash flows, which is really defined by the exposed green amount, is changing in all of them. All right. So in addition to that, remember that it's not enough just to have these positive operating cash flows. They have to cover the cost of capital from your investments. Well, why do the businesses invest at all? Here's the deal, and here's where the link really comes in. They invest to increase their sales, maybe. So they either increase the demand for their their goods, or maybe they do an effective advertising campaign that causes people to be willing to pay more now that they realize the benefits of the product. And so either of those could increase their total sales amount. They may also invest in order to reduce their variable costs. They may put in automation or change their formulas or do research and development or whatever else that allows them to lower their per unit costs. They may invest to reduce their fixed costs. And so some companies, as an example, that maybe are currently leasing office space might go out and buy a building so that their periodic fixed costs go down since they aren't paying all of that rent and lease cost. They could shorten the time between the production and sales. so that reduces the likelihood that there's going to be a mismatch between the quantity produced and the quantity sold, and therefore reduces the risk that they're going to get a mismatch on their cash flows. Or they could possibly invest in improving the ability to forecast the quantity sold, so that brings down the riskiness of that. So there's lots of things that they could invest in to help put them in a better financial situation in terms of their operating cash flows. Well, the gotcha is that they have to have the money to invest, so they've got to go find those funds someplace. So one thing they could do is they may have cash on hand, in which case they just got cash sitting in a cash account. They use that for the investment. If they do that, we would view that as money that could have otherwise gone to the equity holders, and so it's like raising the money from the current stockholders. Or they could go out and raise the money externally, which may involve maybe going to a lender. It may involve selling more stock to stockholders. There's lots of possibilities there. But the bottom line is that they've got to go get that money from someplace. If there's no such thing as a free lunch, so that money has an opportunity cost at a minimum to the people that could have gotten it if it wasn't spent on this. And so there is a per dollar of investment cost of capital that comes with the money that's raised. And so if I go raise more money, I'm going to wind up having a higher total dollar cost of capital by doing this. And so anytime I do a new investment, by virtue of the fact that I do the investment, I am going to increase the dollar amount of cost of the investment capital to the company, just because I've got more investment tied up. So a simple way to think about this: imagine that here's the total investment you want. Let's just say it's $1 million, and you go get half of it from equity and half of it from debt. So you've got $1 million of total investment that you're going to put into doing something, right? And now you've got to turn that into its cost. And so, on the debt side, maybe the debt costs you 10% or 15% of its value. And so that cost is a tenth as tall as this, right? And the equity might cost you, call it 15% of its value. And so even though you raise the same amount of money from equity, it costs more usually. We'll talk about that later. And so you combine those two, and that becomes the cost of the capital for the investment. Okay, so if that's 100 million, and this tends to be an annual cost of capital. So you're going to raise $1 million. Your annual cost might be $15 million or $20 million or something like that. Okay, now the gotcha is this: so I have to go raise that money, and I have to make sure that after I've paid for that cost of capital, that there's still money left over, which means that I have to make sure that the operating cash flows that I'm going to get from the investment are going to be more than enough to pay this cost of capital. That's our job. And so the simple way to think of it is, let's just say here's the benefit in terms of incremental operating cash flows that I'm going to get from this investment. And I'm saying that might be $40 million. I need to be sure it's bigger than the cost of capital. Okay. If it's not, it looks something like this, then obviously I don't even cover the cost of capital. I'm going backwards in terms of growing the value of the firm. And that's obviously not good to us. So at the end of the day, the challenges wind up being this. Companies are built based on entering into business opportunities, and they may start out with one and either modify it or add new ones or whatever. But a business opportunity has to be suitable to them, and it's suitable if it has a suitable combination of market and price and demand, variable and fixed costs, consistency between the quantity produced versus sold, and level of required investment versus the cost of capital. So you have to take all of those into consideration in order to find something suitable. It's suitable if it has a high likelihood of generating sufficient operating cash flows, which come from the price and market demand, variable and fixed costs, and alignment between quantity produced versus sold. Those generate your operating cash flows, that along with the required investment. So it's suitable if all of that is there, that you have more than enough um, cash flows generated out of all of that to cover the cost of capital, right? And ideally, you would want it to have a low likelihood of being insufficient to cover that. So I talk about likelihood because, again, there's a riskiness, there's an uncertainty around how this is going to work out. But what you would like to do is say, well, it's one thing for it to be uncertain. It's another thing for there to be a part of that distribution of uncertainty that's negative, right? I don't, quite frankly, if I've got a sort of a what's left over after all of my operating cash flows and cost of capital and everything are in there, and there's a range of uncertainty, but every particular point in that range of uncertainty is still positive, I probably don't care so much about that, right? But if it starts to trail off where some of the sort of worst case scenarios that I might encounter could be a big loss, I'm probably going to care about that more. So ideally, I want to find opportunities where there's a much higher likelihood of it doing well and growing my value, and a fairly low likelihood that it's going to lose money. And if it's going to lose the money, hopefully it's not a lot of money, right? Now, that last slide sort of spoke to that you need to find those opportunities. It's not enough to just find them. Companies not only have to be good at finding the opportunities, then they have to actually take the steps to acquire or build the business. Then they have to have managers that will manage to the expectations that were set when the investment was made, and ensure that they either meet or exceed whatever the operating cash flow expectations were. And so you got to have processes in place to compare against that, budgets and so forth. And if you do find that you have a business that just, it's not going to live up to what your expectations were, and has a real possibility of generating negative operating cash flows in the future, you need to be able to identify that underperforming business quickly and figure out an exit strategy. Either you're going to fix the business or you're going to exit from it, to take care of this problem so that it minimizes the impact on your operating cash flows. And so you have to be able to do all of that well, quite frankly, to achieve your goal. And that, in a nutshell, becomes what the job of financially managing a firm is. So it's not, I know from other folks that I've talked to, they get the impression that finance is really about going out and doing wheel and dealing deals, or raising money from shareholders or whatever else. Financial management is much broader than that inside of a firm. It is making sure that from a financial perspective, the firm succeeds. And so it's not just done by the finance department, it's done by the managers throughout the entire company. And that's why we teach it as a core element of a business administration degree, because everybody that is in business, in a for-profit business, let's just say, at some point has some responsibility for financial management of the firm. Anyway, that's hopefully, I know that's a lot long-winded, and I don't know that your response will be quite that long, but I wanted to give you sort of a deep dive, if you will, into this. Thanks.